Okay, let's dive into this. Today we're doing a focused deep dive, a really interesting one actually.
Oh, yeah. What have we got?
It's into a source that's quite concise, but I think potentially pretty powerful. It's called Mancy's Trading Tip.
Mancy's trading tip. Okay,
Yeah.
sounds specific.
It is. It lays out a really clear, almost like a set of rules for how you might approach stock trading.
Right, a framework. I like frameworks. They can be helpful.
Exactly. So the mission for us today for this deep dive is
Okay.
to really unpack the core ideas behind this specific tip.
Okay.
What does it suggest about maybe combining different analysis styles? And what little knowledge nuggets can we pull from it's basically three straightforward rules.
Three rules. Sounds manageable. It suggests a blend, maybe, a disciplined approach.
I think disciplined is the key word. So let's get into it. The first rule, kind of the foundation here is shortlist the stocks on the basis of fundamental analysis.
Right. Step one. So this is classic fundamental work for anyone listening. This means digging into the company itself.
The health of the business.
Exactly. Financial statements, earnings, debt levels, who's running the show, how they stack up against competitors. The basic question is this actually a good business,
Look,
fundamentally?
So we're not talking about jumping on a bandwagon here or, reacting to some breaking news alert. Not yet, anyway.
Not at this stage, no.
This is about doing the real homework first, filtering down all the possible stocks to just a group that passes like a quality inspection based on their real value.
Yeah, building that initial watch list, it's all based on merit, on the underlying strength you see in the company's numbers and prospects.
Quality first.
Precisely. The tip basically implies you use fundamental criteria, whatever yours might be, to make that huge universe of stocks into something manageable.
Like running a screen.
Exactly, like applying filters. Maybe you're looking for consistent growth, strong balance sheets, low debt, maybe a good return on equity, stuff like that.
Identifying stability, long-term potential, before you even think about the chart.
That's the idea. This step is the gatekeeper, the first hurdle a stock has to clear.
Okay, makes sense. So you've done your homework. You've used fundamental analysis. You've identified businesses you'd actually be happy to own. You've got your short list.
Your curated list, yep.
What's Mancy's tip say is next. Rule 2 is take entry on the basis of technical analysis.
Ah, okay, so now we bring in the charts. This is where timing enters the picture.
Right.
Once you have that list, that fundamentally sound group, then you switch hats, sort of, and look at the technicals. Price action, volume, pattern support, resistance.
Indicators, maybe. Moving averages, RSI, things like that.
Could be, yeah. All the tools in the technical toolbox.
So just to be clear, you've already decided what looks good based on fundamentals.
Yeah.
Now you're using technicals just for the win.
That seems to be the core idea here. You're not using TA to discover stocks out of the blue.
No random chart surfing.
Exactly. You're using it specifically to pinpoint a potentially better time to get into one of those companies you already vetted, already believe in fundamentally.
Finding an optimal entry.
Yeah. You're looking for a signal from the market itself. Maybe it's a price breaking through a resistance level, suggesting momentum is building.
Or maybe bouncing off a support level, showing buyers are stepping in.
Right, or some classic chart pattern emerges that suggests, the path of least resistance might be upwards now for this fundamentally good company.
So that combination, that synergy,
Yeah.
that's really the heart of it, isn't it? Fundamentals for the quality check, technicals for the timing trigger within that quality group.
It seems so. You're trying to marry the long-term view of the business health with the shorter-term dynamics of how the market is actually pricing it right now.
So you avoid buying a weak company just because the chart looks amazing.
And you avoid buying a strong company at, the worst possible time, technically speaking.
You wait for the market to give you a bit of a nod.
That seems to be the intention.
Uh,
But it doesn't stop there. There's a third rule, and like you said earlier, it sounds pretty emphatic.
It really is. It's stated very clearly. Under no circumstances should you trade in fundamentally weak stocks. Full stop.
Yeah, that's drawing a very hard line. It completely reinforces that fundamental strength is paramount in this system.
So even if, let's say a stock looks terrible fundamentally, but the chart is showing the most beautiful breakout pattern you've ever seen.
According to this rule, walk away, don't even think about it.
It's like a final veto power based on fundamentals.
Absolutely. The technical setup becomes completely irrelevant if the underlying business is deemed weak.
Okay, but what does weak mean in this context? It's not just like a bad quarter, right?
Probably not just one bad quarter, no. It typically implies more serious, persistent issues. Declining revenues year after year, maybe profits turning into losses, debt piling up unsustainably.
Negative cash flow, maybe the whole business model is shaky.
Exactly, those kinds of fundamental red flags. The tip argues implicitly that the inherent risk in owning a piece of such a struggling business just isn't worth it, no matter how tempting the chart looks for a short-term trade.
It's a risk management rule, deep down.
Definitely. It's designed to keep you out of potential value traps or companies that are, frankly, just circling the drain, even if the stock price has a momentary bounce.
It reminds me of that car analogy. You wouldn't buy a car, even if it looks pristine on the outside and is parked perfectly, if you knew the engine was shot.
Perfect analogy. The fundamental health is the engine. Mancy's tip insists that the engine has to be sound before you even consider when the best time to buy the car might be.
The shiny paint job, the technical pattern, doesn't matter if the engine's broken.
Precisely. That third rule is the ultimate safeguard here. It ensures you don't ignore the engine trouble just because the car looks appealing for a moment.
Okay, so let's recap Mancy's trading tip as we've unpacked it. Step 1. Use fundamental analysis to build your short list of quality companies.
Filter for strong businesses first.
Step 2. Use technical analysis, the charts and indicators, so typically to find your entry point for those pre-approved stocks.
Timing the entry into quality.
And step 3, the big one. Under no circumstances trade fundamentally weak stocks, regardless of what the technicals might seem to suggest.
Absolutely. Avoid the weak ones. It's a clear, sequential process. Quality first, timing second, with a strict risk filter.
So this deep dive has given us a really clear look at this one specific approach, this perspective on combining these different types of analysis.
It's a very structured way to think about it, prioritizing that fundamental health above all else, really.
Thinking about this tip then, and how it really forces you to start with that fundamental deep dive. What does that tell us, or what questions does it raise about how long-term company health relates to those, shorter-term market moves we see on the charts?
That's a great question to ponder. How does that fundamental reality eventually assert itself, or how should we weigh it against the immediate sentiment reflected in the price? It's the perennial question, isn't it?